All right, guys, back again. Devon Bell, CEO and founder of Global Currencies. So we're gonna pick right back up where we left off in the last video. Still got the same chart open. Just took a little break, but we're gonna jump right back into it. We're covering economics. This is Forex 105. All right, and so in the last video, this is where we were at. All right, we did some quick plotting of just some support and resistance, supply and demand zones, and I was talking about buying, UJ, and then looking to sell it afterwards. Uh, and so before we really jump into that, and instead of just telling you a quick, simple answer as to why, um, we're gonna really delve into economics. All right, so make sure you have your notes. Get ready because this is gonna be a dense lesson, but we're gonna breeze through it. All right, so you know, throughout the history of a chart, if we zoom in, we can see a lot more current information. We see that gap that happened. But I mean, before we even do that, it's good to know how strong your support and resistance levels are. So like this right here, both of these both of these support levels were very strong. So when it got rejected, just based off of chart analysis, when it got rejected that second time, it would have been an okay signal to buy, but you wouldn't want to confirm it until you have something else. And so we see that head and shoulders right here. I'll draw it out so you guys. It's that same head and shoulders that we were talking about. So you've got a shoulder right here, you got your head, and you got another shoulder getting ready to form. This would have been a good entry, but just right before it, look at that, just right before it, if it had passed this point, that's when I'm going to place that buy. But seeing as how it came up just short, right? I mean, that would have been a nice profit, but it's better safe. It's always better safe. At the end of the day, didn't lose any money. And in that last video, I'm not sure if I mentioned that, this is a demo account because this is a platform that, we're testing. We're still making some changes, but I'll keep you guys updated on when it's ready to go live for you all to test out. But yeah, so for now, we can see that these levels of support right here, this supply zone, because you got two support lines right here means supply, means that the market is going to go up. Okay, same thing with down here. This is support, and that's your demand. So in regards to economics, we need to be able to track that. Okay, so if we're trading economics, we have to be able to track the economic cycle. Now, for people who know more about business, it's the same as the cycle of a business, or the business cycle, right? You have your peak and you have your trough. Okay, you always have your growth. In economy, you track growth and trend. So we're going to be tracking all of this. Now, the only thing that isn't necessarily too relevant is recession and recovery, because just because the currency pair is going down doesn't mean it's in a recession, or just because it's going up. I mean, when it's going up, it is more of a recovery, but the recession is not so relevant. But you still need to be aware of these terms. So that quiz, I hope you aced it and you retained that information, because we were just talking about support and resistance. That's what your peak and your trough are, or your trough and your peak. So uh, so basically, let's see, how do we? So here, right, we have our trough, we have a peak, we have a trough, and then we have a peak, right? Here we have a trough, we have a peak, and you can say we have a trough, a peak, and then another trough. All right, so that gives us a good indication of where the market is. Okay, just like I said, news could happen at any point in time and could completely, if you were going to place a buy here for whatever reason, it hit, it hit support twice, so it's going to go up. You would have lost a lot of money, especially if you didn't have a stop loss. But more than likely there was a major news event that happened that caused it to spike like this. And now zoomed out all the way this far, there's no way I would have caught that trade, because that was quite some time ago. But when you zoom out further on your chart, you can actually see what part of the economic cycle your currency pair is. Now, that's not a direct indication of what each currency is going through. That's the combination of the two currencies combined, which is still important because it's still relevant, right? So here we can see that it hasn't been this low in a while. Just like up here, it hadn't been that high in a while. So you were looking for a time to sell, and this was news, right? This was news. All those major spikes, major breaks, those are all news. And this right here, it's a gap, but it's also news. And so we can actually see, just by charting this by the eye, we can actually see that this right here is a pivot. So this was a previous pivot, meaning that it now became resistance. So it was support, support, and it broke through, so it now became resistance. Only thing, it just didn't even hit it until now. So I'm just giving you guys ways to track the economy of merging the pairs. All right. Now you'd want to do the same thing for each currency, and the way that we do that is by economic indicators, right? And now in the last video I told you we have different types, so this is where I break that down, right? We have leading indicators, coincident indicators, and lagging indicators. Okay, write that down, because the different classifications are what's gonna make or break your trades. Okay, so for leading indicators, right, these indicators change before the economy does. So if we're tracking the economic cycle and we notice that there's a peak, right? If we know that there's a peak, already subconsciously we're thinking of a way on when to enter a sell, right? So now we would be looking for that indication that would tell us to place the sell. Now, how we do that is with these leading indicators. Since they change before the economy, these are useful short-term indications. We're looking at the stock market, we're looking at manufacturing productivity, money supply, and corporate equities with respect to GDP, gross domestic product. We're looking at the housing market, and we're looking at level of new business startups. Okay, and so I mentioned a few of these in the last video. I didn't necessarily go over them too much, but these are my top 5 leading indicators. Now, upon the hundreds, if not thousands, actually thousands, because there are hundreds of economies, among those you'll find other ones, but these are the ones that I've been tracking the longest. These are the ones that I have seen. Like, basically, if you have an indication that resides in one of these 5, you're going to know what the market's going to do, or you're going to know what that currency is going to do. Now you need to figure out what the other currency is going to do, so you can catch one of those spikes. A lot of people, when Brexit happened, right? That was, I I know people that lost a lot of money, but I don't see how. Uh, I mean, they weren't tracking the economy. So that, I mean, that's very important, right? So stock market, manufacturing productivity, money supply and corporate equities, with respect to GDP, the housing market, and level of new business startups. Now, these change before the economy does. Okay, and so I actually noticed something in the last video. Uh, in a way that we would apply that, right? With this being number 2, manufacturing productivity, and in respect to the United States dollar versus the Japanese yen, right? If we look at the calendar, actually, yeah, Wednesday. If you look at the calendar, like I said in that last video, the crude oil inventories report. All right, this I believe is a weekly. Yeah, this is a weekly report, and this is known to have a larger impact on the currency, right? So possible variations in the number of crude oil barrels available and inventoried by companies during the previous week. Now, it says the usual effect is no significant effect, subtends bearing on inflation as well as growth. Now, remember inflation because that's also another one of our indicators. So we need to know that even though this report may not, crude oil inventories, here would actually be a manufacturing productivity indicator, which would change before the economy. But since this specific report tells you that it subtends to have a bearing on inflation as well as growth, right? We know that, I mean, it'll make more sense to you in a second, but we know, okay, it has an effect on growth. So, and it also has an effect on inflation. So those are what we track now. So we went from manufacturing productivity and it being a short-term indicator that changes before the economy to something completely different. All right. A lot of people, they might miss that. If they knew all of that stuff, they might miss that transition. And here's a note. Although this indicator represents data recorded in the United States, it has a greater impact on the Canadian dollar due to the considerable size of the energy sector in Canada. So, right, it's telling us that one, in the U.S. is going to have a direct correlation to inflation, right, as well as growth. So we can mark that down for Wednesday. All right, so we come over here and Wednesday, USD inflation growth. Okay, and I mean, I'm sorry this isn't as pretty as it wasn't planned out, but it is Sunday, and this is when I'll usually do my analysis, so I went ahead and did that. All right, and so like I said in the last video, you want to be more aware of the whole week, and so I think Thursday or Friday we have unemployment. Yep, Thursday we have unemployment, which I mean that's one of the big ones. We got FOMC, but like I said, I like to look at the much larger impact, and unemployment just happens to be one of those. So in the leading indicators, we saw Wednesday USD inflation and growth. Now coincident indicators, these are my top 3. Okay. Coincident indicators, they generally shift just as the market does, meaning some people, they might see a change in manufacturing productivity. They might enter, productivity might have been not as it might not have been up to par. So they saw the report, they entered the sell, right? But these indicators change before the economy does. Whereas they could have entered too soon, right? If you did that manufacturing productivity trade and you didn't recognize that inflation and growth are actually going to be affected, you could have entered a trade too soon, and you you would have blamed everybody but your analysis, everything but. So in this case, coincident indicators, when you see that news report that hits, and just as that report hits, the market starts moving in that direction, right? So there are many coincident indicators such as GDP, gross domestic product, industrial production, personal income, and retail sales. A coincident index may be used to identify, after the fact, the dates of peaks and troughs in the business or economic cycle, right? So, not only will these reports give you indications on what to do now, right? You only place a trade now, right? You only place a trade at once, as if a report happens, you just happen to open up your chart and you see, oh, this report happened 5 minutes ago, let me place this trade. You only do that when you have enough indicators telling you why. So it might take you an extra 5 minutes. You might lose an extra 50 pips because you're doing proper analysis, but in the long run, it's going to save you more money. Okay. So not only will it allow you to do that, but coincident indicators, they also help you identify peaks and troughs, as I was saying earlier, right? The main goal is to figure these out. So when we're looking at a chart, we not only want to see what's going on in the higher time frames, but I know some of you people, you want to enter trades yesterday. So we need to be able to see that. And so here, here we actually have a trough, right? And so now we're looking for a peak, which, like I said, a lot of stuff was telling us to buy, but I personally wouldn't have entered that trade. I'm not going to tell you I would have just because it went up, but I personally would not have entered. Now, where I would enter is a break below this support. That's that gap I was telling you about. So I'm keeping that on my radar. Now, in regards to coincident indicators, we have unemployment rates, industrial production, NFP, non-farm payroll employment, right? So these are directly related to GDP, industrial production, personal income, and retail sales of the economy. And these will shift as the market does. So, right? So on Thursday, we have unemployment. Okay. I know I'm moving around a lot. This isn't scripted or nothing. But on Thursday, we have unemployment. So if we're doing our analysis now and we can, we have a good, solid foundation as to our knowledge of what the market is going to do. We have enough days to do that. So we need to know what the employment rates are going to do for the United States dollar. Now, in this predicament, it's actually going to play in our favor. Okay, so measure the percentage of people of working age who are out of work, but who were committed to actively looking for a job in the previous month. The usual effect is actual, meaning unemployment rates aren't this, big thing that you're hoping is going to be right. There are some reports that you just hope that the forecast is actually what happens. Now, unemployment just happens to be one of those that is highly accurate. Okay, this is published monthly, around 30 days after the end of each reference month. Note, tends to have a limited impact on employment data in other countries because the Japanese economy is more closely centered on the industrial sector than on personal levels of expenditure. Okay, so it's not going to have that big of an impact on the yen, but it's going to have a huge impact on the United States currency, the US dollar. But let's see. So we see that the yen is more closely centered on the industrial sector than on the personal levels. Okay, so with that, we can take note that Thursday, USD unemployment, right? So since Japan, they their economy is more on the industrial production side, and our economy is more on the unemployment side. Take note of that. JPY industrial. All right. So if we have reports on the same day, the same week, where both of these are favored, meaning that, if like industrial Japanese reports are going to be less than the previous, and unemployment rates are going to be lower than the previous. I mean, we're talking numbers here, because now the United States dollar is going to increase while the yen is going to decrease. So if you're buying the dollar and selling the yen, when you place a buy, imagine how much that leverage is going to spike that currency pair. All right. So that's coincident indicators. That's leading indicators. Sometimes you can. I mean, when you look through your economic calendar, you want to take note of as much as you possibly can. So even though I'm not trading by this FOMC, I'll still look at it, right? It's the usual effect is more aggressive than foreseen, means that it's good for the currency. Okay, but there's not that much data on it. Member with voting rights at the FOMC since 2010. So personally, I won't trade based off of it, but some people will. Some people, that might be one of their indicators that they choose to trade by. All right, Friday, Euro, we got USD right here. Consumer sentiment is also a big one. Okay, so before we get on that one, I mean, you can see it's going to be a very busy trading week for the United States dollar. All right, but last but not least, we have lagging indicators. I see a lot of people they failed. They fall victim to this one because, again, they don't know the difference between economic indicators, and they might see a report. Like I said, here they might have gotten tricked. They might have entered too soon, and then here they entered way too soon. All right. Typically, these indicators change after the economy shifts and provides future analysis. So once we've analyzed our peak, a lot of people, they were looking for that buy, right? A lot of people, they were relying on that buy. It happened, but now they don't know what's going to happen afterwards. Some people, they might have sold based on that economic indicator. They might have sold right here or right here because they see this is resistance, and there's an indicator telling them to sell, but they could have entered too soon, because now that it's Sunday, it shot up. I mean, now it's getting ready to fall, but they entered too soon because that indicator was a lagging indicator, which will give us future analysis. You use this as a reconfirmation tool. So these other ones, they are strong indicators, but you want to have a lagging indicator. Okay, just because it won't give you that trade right away, you still want it. Okay, don't rely on lagging indicators only. The biggest impacts that affect the consistency of lagging indicators or market psychology, public view of events, and government decisions, or whether the Fed will raise or lower interest rates. Okay, so interest rates is one. This will impact the decision of world portfolios and foreign investors of an economy. So when you talk about investing in investment portfolios, there are what's called world portfolios, where some people, they might invest in the S&P or the Dow Jones, and they might invest in the entire index, and so you're betting that all the Fortune 500 companies, you're pretty much betting that the U.S. economy is going to do better over time. And so with world portfolios, you're investing in, I mean, just that, you know, worldly indexes. So I mean, I'll get into that. That's more of the next course. That's more of the associates course in GCU. But for now, I know a lot of people are trading using Bollinger Bands. Okay, Bollinger Bands is a big one because people, they look up strategies, they use Bollinger Bands, and I mean it's definitely a powerful tool, but they don't know how to use it, right? When you get a confirmation to enter a trade using Bollinger Bands, I mean not only do you want other indications, but this is a lagging indicator, and I mean it's not an economic indicator, but it's a lagging indicator. All right. Sales are a past performance indicator. All right. So changes in GDP, income and wages, unemployment. Uh, so I mean, unemployment's both of them actually. Um, CPI, which is Consumer Price Index, uh, basically plays a huge role on inflation. Currency strength, interest rates, corporate profits, balance of trade, value of commodity substitutes to the US dollar. So all of these, notice this one has far more. Uh, this one has much more to follow. So based on everything that we know, I mean we want to look at CPI. Uh, we already have unemployment up there. Let's see what else. Oh yeah, we want to look at GDP, and we already have so income and wages. I mean that's one, but I don't think there are any reports that are coming out uh, this week. So if we take all of this, we put it together, right? We already know what part of. I mean, we've already established what part of the economic cycle we're in right now for this pair, right? We hit a trough. Now we're hoping that this is a peak, which right now there's really only one indicator that's telling me that it is, or actually two. My bad. You have this pivot. Uh, it used to be support. After it broke through, became resistance, so it's a pivot. We also have the reverse head and shoulders that shot it up, but now we have that gap that we're looking for it to fill. So that's two. I'm not going to trade based on that, but what I will do is I'll look at what it's going to do for the rest of the week. All right, and if I can figure out tonight what it's going to do this week, I can actually enter my trade early. I might be able to catch an extra 50 to 100 pips. All right, so that's mainly what we're focused on. So in order to do that, I just went to all so we can see everything that's happening. So JPY leading indicators, we've got the level of corresponding composite index calculated from 12 economic indicators. The actual is greater than the forecast, means good for the currency. We want something that's going to be bad for the currency. Okay, so they have it forecasted at less than the previous. So we'll know when this actual number pops up, we'll know what this will do to that currency pair. Uh, Now, that doesn't happen. That happens tomorrow. So we'll keep that in mind because, I mean, it actually looks like it might push this down even more. So, we'll definitely know more pretty soon, actually. Let's see, we got job openings, right? That's another one that we we needed information on, which was unemployment. So job openings are reciprocal to unemployment, but in this case it's jolts. So the impact is low. The actual is greater than the forecast. Is good for the currency. We want it to be good for the U.S. currency. So if the previous being lower than what the actual forecasted report is, that means that we want the actual to be greater than this, right? So if the report comes out and it's 5.69, I mean, the actual will be greater than the forecast, which means the US dollar will actually go up. All right. Now, in regards to this trade alone, we want the US dollar to go down. But in regards to everyday life, we want the US dollar to go up. All right. So we have Japanese yen. Let's see. So we got one for the yen that's up for debate till later tonight. We have one for the US dollar, right? And then we have this other one that comes out, is that Tuesday? Yep. And this has a decent impact. So it's actually forecasted to be the same as the previous. So the value difference in the import-export balance relating to goods, services, credit flows, and unilateral transfer during the previous month. So if the current value is greater than the forecast, it's good for the economy. So we want the current value to be less than the forecast. It's published monthly. This data is seasonally adjusted, not be confused with other counterpart indices, not seasonally adjusted, published by some other press agencies. So, I mean, there's plenty of stuff that you can look through. I showed you the ones that I was looking at earlier for the week. Now, these other ones, they are going to have impact. They're going to be your daily movements. But I personally want to look at these. There's not always going to be high impact ones, so you want to take advantage of them when you can. So I mean, I'm not gonna. This video is already 30 minutes. I'm going to wrap it up here. Now, just keep all this information in mind. Now that you are aware of the difference between the indicators, the different types, you have your leading, your coincident indicators, your lagging indicators. Make sure you write this down. Write down a few of them that you want to use. So up here we have inflation. We also want CPI. All right, forgot to write that down. Oh, never mind. I actually did write it down. So we're good to go. All right. So, take notes of this. There are plenty of indicators out there. There's actually a list. If you go to the exchange and look up economic indicators, you'll find the complete list. I'm continuously adding to that list, explaining, the different types. There's different money supplies. There's M1 through M5. Most people only track M1 through M2. I tend to track all of them. All right. So, that's the basis. That's the underlying basis of tracking economies. Okay. And like I said, with that buy, I wasn't going to get on the buy, but after it had made its move, I was going to be looking for the sell, and that's what we're doing now. So one of my entries will be a break below support. A break below support is going to give me a good confirmation to enter, but I will probably enter 5 to 10 pips after the break below support, because one thing we have here is another level of support. Okay, and I'm not going to get faked out, so I'll be looking for that to break through both levels, and then also I'll be looking at what the economy is doing. Since we did hit a peak, we're still looking at a sell, but for how long? It might be until tonight, in about 6.5 hours when that other report comes out. That will tell us what the yen is doing, and then later tomorrow morning we'll see what the US dollar is doing, and that'll begin our fluctuation for the week. Until then, this chart is moving too slow for me right now, but you know, that's the forecast for the week, as well as as well as explaining economics to you guys. So again, Devon Bell, I'm welcoming you guys to the university. You see, we have a lot going on. We have the glossary, just in case there's some words that you don't know. I mean, we've got handouts, videos, like webinars and other trade room sessions that we recorded. There's books. I mean, I highly suggest you guys take advantage of all these resources. Indicators, and here you'll find just various indicators that they will help you maximize your strategy. On this chart, I haven't used any indicator yet except for support and resistance, but I do use a few. And as we delve deep, I'm starting this over from the beginning with support and resistance and showing you how it correlates to economics, right? Because if you're just placing support and resistance lines only for the wicks and you're only trading just because of that, then you might get lucky a couple of days, but for the most part, your account's going to get taken to the cleaners. But if you're actually entering trades using support and resistance and economic events, your chances of success will increase much more. But I want you to be more than that 85%. I want you to be more than that 95%. I want you to be 97% successful with your trades, because even that other 3% can blow your account. Okay, so that's also, we have a more in-depth course regarding risk to reward, how to calculate it, how to calculate your lot sizes, how to calculate how many pips this candle is going to is going to fall before it closes, because that's also important. Now it's definitely a lot harder to track on a smaller time frame. You want a much larger time frame, but everything is relevant, from the candlestick patterns to fundamental technical analysis, market psychology. You want to use all of that in regards to economics, and you'll stop being that 60%, right? Because 60%, that could just be luck. You could just be getting lucky with your trades, but you'll actually know when you start placing the right lot sizes, not blowing your account, and your take profit levels aren't getting shorted. And what I mean by shorted is you're not getting the market makers aren't moving to just that half a pip before you take profit, and what happens afterwards is it goes and hits your stop loss. Like, you don't want to be one of those people. So you want to be able to calculate everything that's coming in the advanced mathematics course. So there's a lot to look forward to. 105 will get you trading live and very successful. I just want you guys to take dense notes, pay attention, watch this a couple times if you need to, and track each economy. That's something that we didn't do in this video. I'm just explaining how to do it for right now. In this video, all we did was track the UJ, United States dollar, crossed with the Japanese yen. Now I want you to actually track the US dollar by itself and the yen by itself. The moment that you see, for instance, if this chart right here, well, let's turn off the scrolling. Okay, if this right here was the US dollar, right? We see the peak, trough, peak. And if this chart right here was the yen, and we see how the yen is steadily going down, but it's expecting to go up, and we see that the US dollar is going up and it's expected to go down. Well, I mean, you put those charts on top of each other, it forms an X, right? That X was this consolidation right here. I'm not saying that this, well, in theory, this consolidation happened because of that, but I'm not saying that's what those currencies were doing at that time. But if we see that the yen is expected to rise and the dollar is expected to fall, we would now be in a sell. Okay, so I want you to actually track those currencies, and I don't care when you watch this video. I don't care if it's 2 years from November 6th, 2016. I want you to go back in your chart, take off auto scroll, and I want you to plot down. I want you to plot this out and see where I got that. All right. So, but that about wraps it up, guys. I'll see you on the next video and in the chat. And thanks for tuning in.